After FICA and income taxes, then we also have any voluntary deductions. The examples of voluntary deductions can include if we're have an HSA account, if we're have insurance, if we're donating to, or if we're putting money into our pension or retirement contribution, we can donate to charity through those voluntary requests. So the employers withhold those from our gross pay, and then they send a massive amount to whoever the agency is, depending on what they're paying, if it's the union dues, or if it's your retirement contributions or your insurance premiums. This is an example of what the journal entry will look like when we're recording an employee payroll. We will have our salary expense, which is our gross pay. The salaries payable then is the net pay, so the gross pay minus all of our deductions. We have our FICA taxes, 6.2% for Social Security, 1.45% for Medicare taxes. The amounts of our income taxes will be given to you. And then we also have voluntary amounts here with medical insurance and union dues. Then when we pay the payroll out, we would pay our salaries payable with cash. So this is the employee's side of the payroll and what we're withholding on behalf of the employee. Now we're going to look at the employer side of the taxes. So what taxes is the employer responsible for that don't come out of the employee's pay? So the employer also pays FICA taxes and Medicare taxes for their employees, and they pay portions that don't come out of the employee's gross taxes. They also pay into the unemployment tax benefit. So then if employees become unemployed, they can collect unemployment. These are the taxes that help to fund that unemployment bank that pays unemployed employees. So we have federal unemployment tax and state unemployment tax. FUTA and SUTA. The federal unemployment tax is 6% on the first $7,000 of wages, but we get a credit for paying the state unemployment tax. So the rate is actually 0.6%. Then for the state unemployment tax, we pay 5.4% on the first 7,000 of wages paid to each employee. This is an example of our employer side. So the employer pays FICA and for Social Security and Medicare. Those rates are exactly the same as what the employee pays. So 6.2% on the first 148,000, I think $200, and then Medicare taxes on all. They also pay the state unemployment taxes and the federal unemployment taxes. And this is an example of a journal entry that we would have for recording what the employer payroll tax expense is for the period. We also need to look at internal control of payroll. So these are the 4 key areas of payroll activities that should be separated and monitored. One is the employee hiring. So the recording of employees into the accounting records for payment. So that's actually one of the places historically where fraud has occurred, is when we put fake employees on the payroll and then have all the checks sent to the same place. Payroll preparation. So who prepares the payroll and make sure that everything is correct for the payroll that's going to be paid out, and that should be separate from the person who then actually pays the payroll. Also, timekeeping. if we're recording the amount of hours that someone works, we want to do that in a way that we are actually recording their hours. So the one of the benefits is if we have some kind of an electronic time clock or a computerized timekeeping that requires employees to sign in and sign out. If we just have an honor system, then the employees might over exaggerate the number of hours that they work. So our multi-period liabilities, things that extend more than one accounting period, are generally unearned revenues and notes payable. So we talk about magazine subscriptions, but other things would be like Prime memberships. If you pay for the year instead of month by month, that would cover that. If you have any kind of membership that you pay a year for and then use monthly, um, if you have a contract where you provide for like 3 months service or 3 years service, notes payable also can extend over a certain time. So we have a 3-year note payable. The 1-year portion would be a current liability, and then the other 2-year portion of that note would be in a long-term liability. Next, we're going to talk about estimated liabilities. So these are the liabilities that's where we get the uncertainty, that we don't know exactly how much we're going to pay out. So we make estimates based on our historical information and record that, so we match our matching principle with our expenses in the right period. So those include warranties and bonuses, pensions, healthcare expenses, vacation pay. So this example is for health and pension benefits. We agree to pay a certain amount of their medical insurance. So when you take out your employer's insurance policy, they are also paying on your behalf. So they pay a portion and then a portion of that gets taken out of your paycheck. They also generally add to your retirement account. So if you take out a retirement account with your employee and you take a payroll deduction for that, they might have a matching program where they match whatever you put in, or they might just have a percentage. Like if you open a 401k with our company, every month we'll put in 5% of your salary, regardless of what you put in. So in this example, we have the employer agrees to pay $8,000 for medical insurance policy and contribute 10% of the employee's gross salary to a retirement program. So we would have benefits, expense, and then their medical insurance and retirement program. Another estimated amount is for vacation benefits. So if we assume that employees earn 2 weeks of paid vacation each year, then we would record the cost of that vacation benefit as an expense and create a liability called vacation benefits payable. This is a liability for when those employees take vacation that we'll record against. So then when an employee takes vacation, we record against that vacation benefits payable and that we paid them cash for their vacation. So this would go on their payroll then the next time they would be able to collect cash. Another estimate is if we have bonus plans. So we either will pay out a percentage of a bonus or we will say we're going to do a $10,000 bonus and it gets shared by all employees. So then we're just going to create a bonus payable. And then later when we pay the bonus out, we will designate which employees get what amount of bonus. So for example, I worked for a company for a while that the bonus amount at the end of the year was dependent on the number of years that you worked there. And the longer you worked there, the better your percentage of the bonus became. So they would just have a flat bonus rate and then separate out on for employees, and then the percentage of the bonus that you earned was based on the number of years that you were there.